So now that we've got that out of the way, let's go ahead and take a look at the One Big Beautiful Bill Act, which was signed into law on July 4th of 2025 by our current president. Now, with the One Big Beautiful Bill Act, it extended quite a few things that were done under the TCJA, which was the Tax Cut and Job Act of 2017.
Welcome to the Tax Relief with Timalyn Bowens podcast. Are you behind on taxes? Is the IRS threatening you or your business? Are you overwhelmed and confused about how to resolve your tax issues? Let's join Timalyn as she explains your options and how she may be able to help. Timalyn Bowens is America's favorite EA.
Hey, family. Welcome to episode 76 of the Tax Relief with Timalyn Bowens podcast, and Happy New Year. I hope the year's treating you well so far. We have, about 10 days until the IRS starts accepting individual returns. So before we get into the swing of things this year, I want to give you an overview of the One Big Beautiful Bill Act because last year I went into detail about a few of the changes like the enhanced senior deduction, qualified tips, qualified overtime. But, excuse me, I want to take a look at the bill overall and some changes that are made for individuals. Now, first, let me give you a disclaimer. I love taxes. I love tax law. I get excited about it. But this bill was huge. And while I did go through all of it, I'm not going to have time to go through all of it here on the podcast. So, what I've picked out are things that I think are going to be most relevant to our everyday taxpayer. And I'll go ahead and let you know as well, if you didn't already look at the time, this episode is going to be a little bit longer. Okay. Now, just like with any tax law changes, provisions, this is not going to be cookie cutter where everything applies to everybody. For things specific to your tax situation, I'm happy to have a paid consultation with you, but if you already have a professional doing your taxes, I recommend that you take your questions to them because they are going to be the best equipped to answer the questions about how these things apply to your situation. Okay? So, now that we've got that out of the way, let's go ahead and take a look at the One Big Beautiful Bill Act, which was signed into law on July 4th of 2025 by our current president. Now, with the One Big Beautiful Bill Act, it extended quite a few things that were done under the TCJA, which was the Tax Cut and Job Act of 2017. That was the first major tax overhaul that we'd had since the Reagan administration. And that was during Trump's first term in office, okay? So a lot of those things were set to expire at the end of 2025. But with the One Big Beautiful Bill Act, it extended and even made permanent some of the changes that came with that. Okay. So the first thing we're going to look at is an increased standard deduction. So the standard deduction is the amount that you are able to reduce your taxable income by each year without having to do anything. It's simply based on your filing status and for our seniors, age. So we have a set amount for our single taxpayers, then we have the standard deduction go up a bit higher for those who are head of household, and then the highest standard deduction is for those who are married filing jointly. Now, for those married filing separately, they have the same standard deduction as single taxpayers. So, since the 2018 tax year, the standard deduction was basically doubled under the Tax Cut and Job Act. But what we saw happen was exemptions went away. So, for a lot of taxpayers, they noticed a difference because they went from being able to have a $4,000 exemption for each member in their family to only having a higher standard deduction. Now, I'll have to tell you, for my family personally, we didn't feel it as much because we are a family of three. So, if we added up our original standard deduction before the Tax Cut and Job Act, and then the exemptions, we were about in the same place, right? So if you're one of the people who, felt that change in 2018, let me know down in the comments. This is also why the W-4 changed so drastically. The W-4 was redone to help people keep more of their money during the year versus paying in extra and getting a bigger tax refund. Anybody else notice smaller tax refunds since the Tax Cut and Job Act? This is why. So, the standard deduction that was made permanent, that we increased, and for 2025, so for the tax year you're about to file right now, for those who are filing married filing joint or qualifying widower or surviving spouse is now, you're going to automatically be able to deduct $31,500 from your taxable income, even if you don't itemize. For single and married filing separately taxpayers, that goes down to $15,750. And then for our folks who are head of household, that is 23,625. Now, I do want to point out that for our taxpayers who are disabled or blind, they do get an additional amount to their standard deduction. For 2025, if we have a taxpayer who is single and they're disabled or blind, they get to deduct an additional $2,000. If we have taxpayers who are both disabled and married, they get 1,600 for each joint filer. So, what does that look like? Let's say we have a disabled taxpayer who is single. The standard deduction for single individuals in 2025 is 15,750. So, because disabled taxpayers have that additional 2,000, the taxpayer would have a standard deduction of 17,750. All right? Now, the next thing we're going to move to is big for those of you who may itemize, especially if you live somewhere like New York or California. We have an increased limitation on SALT, which is state and local tax. For 2018 through 2025, the TCJA limited the aggregate itemized deduction for state and local and real property taxes. That's why I said this is going to be a big deal for those of you that are in California and New York, places that have high state tax as well as property tax. Under the TCJA, it was limited to $10,000. So personally, I had a client who lived in California who between state and local tax was paying like 30, 35,000. But under the Tax Cut and Job Act, we could only use 10,000 of that for a deduction. Well, under the One Big Beautiful Bill Act, that amount is going to increase from $10,000 to $40,000. Okay, for 2025 and then also for 2026. This is going to be huge because now people like my client are going to be able to take advantage of the full amount of SALT taxes that they pay. Now, there's still going to be a limitation based on how much the taxpayer makes. This is going to be based on their modified adjusted gross income. So, if we have a taxpayer whose modified adjusted gross income exceeds $500,000, and this is for 2025, or if they're married filing separately and it exceeds 20, I'm sorry, I was going to say 25,000, $250,000, then that amount is still going to be $10,000. Okay. So it's a $40,000 cap, but it can be reduced based on their modified adjusted gross income. Now, the next thing I want to talk about is huge for my taxpayers who are at least 65 years old or older by December 31st of 2025. We have the additional deduction for seniors, or the enhanced senior deduction. For tax years 2025 through 2028, the One Big Beautiful Bill is going to provide an additional $6,000 that can be deducted, and it's based on age and based on income. So the seniors who are going to be able to take full advantage of that $6,000 are those who have a modified adjusted gross income of $75,000 or less. That goes up to $150,000 or less for my married filing jointly taxpayers. Now, check this out. This is a temporary deduction, all right, which means you have to pay attention to when it expires. So we have 2025, 2026, 2027, 2028. If the next administration does not decide to extend this, then this deduction is going to only be good for 4 years. Now, I'm not going to go into a whole bunch more detail on this one because I did a full podcast episode on it, and I'll make sure that that's linked down below in the notes. So if you didn't catch it, you can go back and take a look at it. And yes, I do mean take a look at it because I did actually do a video version of the podcast for the enhanced senior deduction. Okay. Next thing we're going to look at is the car loan interest deduction. So for tax years 2025 through 2028, there is a deduction for up to $10,000 of the interest paid. But here's the catch. This is going to be based on the modified adjusted gross income of the taxpayer. Okay. So it's going to be completely phased out if they have a modified adjusted gross income of 249,000, and we'll throw the dollar on there, or greater. So as soon as you go over $249,000, we know that it will be completely phased out. Now, that's for our joint filers. For our single filers, they can make up to 149,000. Once we get past that dollar, then theirs is going to be completely phased out. Now, you may be thinking, with the cost of cars right now, who's going to be buying a brand new car at that income amount if that will completely phase out? Well, some people are. So with that, if you're like, hey, I need a new car, I want to take advantage of that, there are a few more catches. The final assembly has to occur in the United States. Okay. In addition to that, only interest for a new car, emphasis on new, I mean brand new car, qualifies. So you can't go get a car loan for a car that's new to you, pay the interest and deduct it. No, that's not going to meet the qualifications and criteria set for this deduction. Okay. Now, the vehicle just has to be a qualified passenger vehicle. That means it could be a car, a minivan, van, SUV. pickup truck, or even a motorcycle. But again, you have to make sure that you qualify for the income limitations. The final assembly is in the United States. And in addition to that, it has to be brand new. Okay. Now, next we have the qualified overtime deduction and the qualified tips deduction. Just going over these briefly because, again, I did do a full episode on both of these right here on the Tax Relief with Timalyn Bowens podcast. I will make sure that those are linked in the notes as well. But check this out. For qualified overtime pay, it still has to be reported, you just don't get taxed on it. And again, this is based on your income. Now, there's a standard set by the Fair Labor Standards Act, FLSA, of 1938, where you're not deducting the base rate that you got paid for the overtime. You're actually going to be deducting the premium. So let's say, for example, you get paid $20 an hour. So for overtime, you get paid 30. For the overtime hours, you're not going to be able to deduct the full 30. You're going to deduct that $10 premium. Now, this deduction is also going to depend on the modified adjusted gross income of the taxpayer. For those who are filing jointly, it cannot exceed 300,000. For those who are a single head of household, it cannot exceed 150,000. Okay? So there's no deduction where it's completely phased out if the modified adjusted gross income reaches 550,000 for our marriage filing jointly people, and then 275,000 for our people who are single or head of household. Now check this out. The IRS, Congress in the IRS did not require employers to report all of the overtime on the W-2 for 2025. Hopefully that's going to be changed by the time we get to 2026. But you want to make sure, just in case there's a mistake, discrepancy on the W-2, that you as the taxpayer also provide your tax professional with your last check stub that should show all of your qualified overtime. Because again, this is in effect for 2025 through 2028. So if your income meets those thresholds, then you could potentially be able to take advantage of this deduction for this tax season. Now, moving forward with qualified tips, if you already receive tip income, those reported tips should have been on your W-2 in the first place. Same thing that I mentioned with overtime. You still have to report them, and then there's a certain amount that you're not paying tax on because you're deducting it. Same thing with the qualified overtime, and I apologize because I didn't mention that. The annual deduction for qualified overtime can be up to 12,500. So if you have more overtime pay than that, I apologize if it was confusing. You can't deduct all of the overtime pay, just up to the 12,500, okay? Now with the qualified tips, this is crazy. And when I say crazy, I mean crazy good. You could potentially deduct up to $25,000 of qualified tips during the year. Now, you have to work a job that customarily and regularly receive tips before 2025. The IRS has released a list of what those jobs are. Okay. Now, whether you itemize or use the standard deduction, this is available to you. But again, we're looking at it based on your income. For those who are filing jointly, The modified adjusted gross income can't exceed 300,000. For those with a modified adjusted gross income of 150,000 if they're single or head of household, okay? Similar threshold as with the overtime if the modified adjusted gross income reaches 550,000 for those filing jointly, there is no deduction, and for those who are single or head of household, it is 400,000. Okay? So, very good stuff for those who work overtime and who receive tip income. All right? Next, this is a big one for those who have children who are under the age of 17. We had the child tax credit go from $1,000 to $2,000 under the Tax Cut and Job Act. Then, with the One Big Beautiful Bill Act, this is going to increase from $2,000 to $2,200. And then the refundable portion of the credit is going to be $1,700 instead of $1,400. So that means this credit can reduce your tax liability by up to $200. However, if your tax liability is already taken care of due to other credits or your taxable income has been reduced so much and the credit is no longer needed to cancel anything out, up to $17,000 of this is going to be refundable to you. So that is definitely a win for those of us who have children. Okay. Next, we're going to look at the adoption credit, which is refundable up to $5,000. So this was created to help with the expenses. No, it's not going to necessarily refund you everything, but the expenses of adopting a child are very high. So beginning with 2025, the One Big Beautiful Bill Act changed the credit so that up to 5,000 of it is refundable. Okay? So this is important to note because the actual credit is higher, similar to the child tax credit, but then the refundable portion is up to $5,000. So if you have spent more than that, there is a formula that is used to figure out how much of a credit you'll receive for the expenses that you paid. And then again, if your liability is already taken care of, the refundable portion can end up turning into a tax refund for you and your family. I got two more things I'm going to cover. All right. Thank you for hanging out. Let's talk about the things that were taken away with the One Big Beautiful Bill Act. And this is not going to be all inclusive, but two things that I want to bring your attention to that came about under the Inflation Reduction Act with the Biden administration. These things were not supposed to be sunset, but the One Big Beautiful Bill Act terminated them. The first one we're going to look at is the clean vehicle credits. This was terminated early, 5 years early. Clean vehicles purchased, and of course, there was a certain criteria met under the Inflation Reduction Act. Taxpayers could receive a credit up to $7,500 and $4,000 for those who purchased a previously owned clean vehicle. Okay, so with that one, you could even purchase a used one and still get up to $4,000 back. Well, you had to know with the car loan interest, there was something we had to give up. And this is what it was. The One Big Beautiful Bill Act terminated these credits for vehicles purchased after September 30th of 2025. So, if you were looking to purchase a clean vehicle in order to take advantage of this credit, I'm sorry to be the bearer of bad news. If you did not purchase it before September 30th of last year, you will not be able to take advantage of the credit. You'll just be helping us keep the earth clean, but no tax incentive in sight. Which, moving along, same thing with the credits for the energy efficient home improvements. What the One Big Beautiful Bill Act did was repeal the energy efficient home improvement credit for properties placed in service after 2025. So, if you did not take advantage of getting energy efficient insulation, skylights, heat pumps, air conditioners, furnace, water heaters, or windows for your personal residence, you still can to keep the earth clean and be energy efficient, but you're not going to be able to get a tax benefit for making these purchases under the One Big Beautiful Bill Act. It repealed what was done under the Inflation Reduction Act with the Biden administration. Okay. So, again, I wanted to cover those because I think they hit a broader audience. And we have listeners who are low income, moderate, high income. I wanted to make you all aware of these things. I apologize, I couldn't cover them all. In episode 77 in 2 weeks, I will be covering the One Big Beautiful Bill Act and some of the implications that it has for business owners. Okay, now, if you're like, oh no, I don't know how this is going to personally affect me, again, I strongly encourage you to book an appointment with your paid tax professional because they are the one that is going to be the most familiar with your tax situation. I'm going to urge you to please, please, please make sure that your W-4 is updated to adjust for withholding, especially if you are one of those people that's going to be able to take advantage of the increased SALT deduction. Because guess what? You don't have to withhold as much because you are going to be able to decrease your taxable income with that deduction again. Okay? If you have a tax problem because you didn't realize how some of these changes were going to affect you, you can book a call with me at www.bowenstaxsolutions.com. But remember, it doesn't have to be me. Just make sure you get the help you need. I appreciate you listening. I appreciate it even more if you shared this episode and help me on my mission to fill the tax literacy gap one taxpayer at a time. I'd like to thank you for taking the time to listen today. I'd like to thank Jim Ray Consulting Services for helping me get this message out to you. I hope you found the information helpful. Did you know 1 in 50 people have a tax problem? Please share this episode with your friends and family because you never know who may need help. Again, thanks for listening. Hey, just as a reminder, this podcast is for informational and educational purposes only. It provides a framework and possible solutions for solving your tax problems, but it is not legally binding. Please consult your tax professional regarding your specific tax situation.